Today, Kiwi inflation eases, but slowly, so rates will remain higher for longer. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, on Wednesday, Statistics New Zealand released consumer price information for the December quarter. The data showed that New Zealand inflation slowed in the final 3 months of 2023, despite indicators of domestic price pressures remaining stubbornly strong, and the estimates came in below the Reserve Bank's expectations. As a result, it appears that policymakers are likely to hold until there's a clearer picture on the economy. While this is the smallest annual rise in the CPI in over 2 years, it remains above the Reserve Bank of New Zealand's target range of 1 to 3%, Consumer Prices Senior Manager Nicola Growden said. The OCR currently stands at 5.5%, and while investors are betting that the Reserve Bank will start cutting the official cash rate in the second quarter, and it will be lower to 4.75% by the end of the year, as discussed recently, policymakers remain concerned about sticky core prices, and most economists now expect the Reserve Bank of New Zealand to delay a rate cut until at least the second half of 2024. In November, the central bank projected that inflation would drop below 3% in the third quarter of this year. Inflation continues to move in the right direction, said Jarrett Kerr, chief economist at Kiwi Bank in Auckland. The current state of play and the outlook should be sufficient to see the Reserve Bank of New Zealand pivot away from rate hikes. Rate cuts are not far away. However, others remain more sanguine. The divergence between the domestic and imported components of inflation helps to illustrate the big concerns that the Reserve Bank of New Zealand is trying to balance, said Satish Rashod, senior economist at Westpac. Inflation is coming down. That will be important for stabilising inflation expectations, and it means that the Reserve Bank of New Zealand will feel more comfortable keeping the official cash rate on hold for now. Westpac believes that the CPI print will keep the Reserve Bank of New Zealand on hold through 2024 because inflation is still uncomfortably high. The easing and underlying inflation pressure will be welcome news for the Reserve Bank. However, digging under the surface, it's clear that the bank can't take its foot off the brake just yet. The easing in underlying inflation is mainly due to falls in retail prices of imported goods. Domestic inflation pressures, which are a bigger focus of the Reserve Bank of New Zealand, are still running hot. And this CPI is showing some encouraging progress towards the Reserve Bank's 1 to 3% target range, but the strength of non-tradables and other core inflation indicators remains. The lower than the Reserve Bank of New Zealand forecast headline outcome will likely make the Reserve Bank of New Zealand comfortable that inflation expectations remain in check, but ongoing sticky core inflation will likely be viewed with caution by the bank, and it will emphasise that has still work to do before they can be sure that inflation reaches 2% in the second half of 2025, as is required by their new, more focused mandate. So we remain comfortable that our view that 2024 will be a year of an unchanged official cash rate, and more indications of declining core inflation will likely be required before an adjustment lower in the official cash rate occurs. And Finance Minister Nicola Willis said more needs to be done to get inflation back under 3%, referencing the government's actions such as lowering spending and reducing regulatory costs faced by businesses. We are focused on removing excessive inflation from our economy and won't be satisfied until we have, she said in a statement. Now, Stats New Zealand said the annual consumer price growth eased to 4.7% from 5.6% in the third quarter, which matched economists' expectations while coming below the Reserve Bank's 5% forecast. Consumer prices rose 0.5% in the fourth quarter from 3 months prior, also in line with estimates. Now, this is the lowest inflation rate since the middle of 2021 and does suggest that the central bank has done enough tightening to achieve its 1 to 3% target. Annual non-tradable inflation, that's a closely watched indicator of domestic price pressures, slowed to 5.9% from 6.3% in the third quarter. Non-tradable inflation measures financial goods and services that do not face foreign competition, and it's an indicator of domestic demand and supply conditions. However, the inputs for those goods and services can be influenced by foreign competition, and nevertheless, the non-tradables were higher than the Reserve Bank of New Zealand's projection of 5.7%. And other measures of core inflation did also decline a bit. Tradable prices, which measures final goods and services that are influenced by foreign markets and so reflect movements in global commodities and imported items, rose 3% in the final 3 months of 2023, which is the slowest annual pace in almost 3 years. And looking at the detail, 8 of the 11 main groups in the Consumer Price Index basket increased in the quarter, according to Stats New Zealand. Housing and household utilities was the largest contributor to the December 23 quarter annual inflation rate, and was mainly driven by higher prices for rents, for construction, and rates. Rent prices increased 4.5% in the 12 months to December 23, while construction and rates increased 3.6% and 9.8%, respectively. The price of housing increased over 2023. Rent is 4.5% more expensive than at the end of last year. And while the price increase in building a new house has fallen to 3.6%, it is 41% more expensive than pre-pandemic, Growden said. The next largest contributor to the annual increase was food, due to rising prices for ready-to-eat food and confectionery, nuts and snacks. And prices for ready-to-eat food increased 7.3% in the 12 months to December 2023, following a 9.4% increase in the 12 months to the September 23 quarter. Confectionery, nuts and snacks increased 9.7% in the 12 months to the December 23 quarter, following a 10.9% increase in the 12 months to the September 23 quarter. And alcoholic beverages and tobacco was the next largest contributor, driven by rising prices for cigarettes and tobacco and spirits. This report comes as 2024 is increasingly being seen internationally as the year of the rate cut, with the Federal Reserve poised to lead the charge for richer countries, or maybe the ECB. While inflation is mostly retreating around the world, soaring shipping costs and a jump in oil prices amid geopolitical tensions are stoking worries about a revival of cost pressures. That said, New Zealand's services inflation has fallen faster than those of other nations. But it will be months before we see rates moving down. Higher for longer remains the tone, which is not good for those hoping the housing market is about to rebound. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.